What is up, YouTube? Welcome back to another video. I'm your host, TheDividendAristocrat, and today we're going to be talking about my favorite REIT, Realty Income. As a reminder, this is not financial advice, and I'm just merely sharing my opinions on this channel. Realty Income Corporation is a real estate investment trust that invests in freestanding, single-tenant commercial properties in the United States, Spain, and the United Kingdom that are subject to triple N leases. According to Investopedia, a triple net lease is an agreement on a property where the tenant promises to pay all the expense of the property. This includes real estate taxes, building insurance, maintenance, and of course the additional cost of rent and utilities. This agreement between Realty Income and their tenants help lower their financial obligations to the properties over time and lowers their exposure to risks due to rising costs of maintaining those properties. Now, as you can see on Realty Income's Who We Are page, they are a very investor-focused company. They take pride in knowing that they've paid over 644 consecutive monthly dividends. They also make sure to show off that their compound annual dividend growth rate since their IPO has been 4.3%, and they have a compound annual return since 1994 of 13.4%, which is absolutely phenomenal. Now, they say that they have over 13,250 properties under those long-term net lease agreements, which we discussed earlier. And looking at their portfolio snapshot, they have a 98.8% portfolio occupancy rate, which is amazing. They're not subject to the same risks as office real estate, so they're able to keep that occupancy rate significantly higher than other REITs. They have over 1,300 different clients, and they invest into 85 separate industries, which helps diversify their portfolio. As you can see on the page, they have trademarked the term the monthly dividend company, which is what they're very well known for and it's what investors love about them. There are not many consistent REITs which offer monthly dividend payments, and aside from Realty Income, the only one that's recently started offering monthly dividend payments that I would consider is ADC, Agri Realty Corporation. Now, if we're looking at their portfolio page, we can see that they have a highly diversified portfolio, and their goal is to generate reliable revenue that supports their increasing monthly dividend payments. So if you're a dividend investor that loves your dividend payments getting increased every single year, you know this company is looking to make that happen every single time. Looking at their top 10 industries by weighting, we can see they have grocery stores here that include stores like Walmart and Sam's Club. They also have convenience stores like 7-Eleven. They have dollar stores like Dollar General, drug stores like CVS and Walgreens, and home improvement stores such as Lowe's and Home Depot. And if you want to see their top 20 clients, we can take a look at that right here. Walgreens being their number one client. Not something I'm super comfortable with, but I think with the rest of the diversification that they have, it's still pretty solid. And if we take a look right here, we can see those 20 biggest clients kind of broken down into their specific categories. Aside from that, they have recently made a $1 billion investment into the Bellagio, which is about a 22% stake in that casino. Now, the majority of their properties are in retail, but they are focused on many different industries. And their top 7 regions, as you can see here, United Kingdom is number 1, but actually if you include it as a country, the US is far larger, with Texas making up almost the same percentage as the United Kingdom. Now, if we take a look at their portfolio occupancy rate, we can see how consistently they've been performing. If I'm not mistaken, the company has never dipped below a 90% occupancy rate, which is amazing. So now taking a look at Realty Income on Seeking Alpha, we can see just like other REITs, they have not been having the best year, down about 21% in the past year. And towards the end of October, we can see here that it dipped all the way down to $46.22, which was a great buying opportunity for a lot of people. Afterwards, it had a bit of a climb back up towards almost $60, but since then we've seen another decline down to $52 per share, which potentially gives people another buying opportunity if they're interested in this company. Now, I do want to clarify that I am long Realty Income, and I hold it in my Roth IRA, not in my regular investment account, so I have actually been picking up shares at these prices, but of course, as always, do your due diligence before you invest into any company yourself. This is not financial advice. If you guys do like the video so far, please make sure to leave a like. It helps out the channel a ton. And if you haven't subscribed to the channel yet, please do so. I'll be posting weekly videos going through my portfolio and different companies that I'm looking to invest in. And hopping into their financials real quick, we can see that their revenue has been increasing nicely over time, right now hitting about $3.3 billion. Of course, some of that going forward is going to be from their new acquisition of Spirit Realty Company. But regardless, we like to make sure that the revenues are increasing over time. While we're here, I want to point out real quick that their weighted average shares have been going up over time. This is one of those graphs that you do not want to see increasing over time. That means that in order to make more acquisitions, they've actually been liquidating more shares and reintroducing those into the market. What it means for you as a shareholder is that you are losing equity within the company. So every time they sell shares, your shares are technically worth a smaller percentage of those shares outstanding. Now, with current interest rates, it does make sense to sell more shares in order to raise capital rather than having to take out loans at these crazy rates. However, as shareholders, it definitely hurts, and I do hope that they slow this down in the future and hopefully start buying back shares once the rates go down. And I also want to take a look at the AFFO per share. So as we can see here, that's been increasing over time, which is great. Of course, we don't have this year yet, and we'll see what they do once they announce their earnings for the entire year of 2023. Now, hopping into their dividend stats, we can see that their dividend yield is sitting at 5.88%, right under 6%, which is pretty solid. Their annual payout does come out to $3.08 per share. Their payout ratio is sitting at 74%, which is on the higher end, but with REITs, this is to be expected as they pay out a lot of their earnings in dividends. And their 5-year growth rate for their dividends is sitting at 3.66%, which is not incredibly fast, but they do pay it out monthly, so that compounds very quickly. And as we can see here, they do have a dividend growth history of 26 consecutive years, making them a dividend aristocrat. Now, one thing I do want to mention with this dividend is because it is a REIT, it is taxed at an unqualified rate. So if you're holding in your taxable investment account, your taxes may be higher on those dividends compared to your other holdings. What a lot of people do in order to avoid this tax liability is they put into their retirement account, such as a Roth IRA or just a traditional IRA. And if we look at their AFFO payout ratio over time, we can see that has been decreasing nicely. So 75% is much more safe than it was just a couple years ago. And comparing our dividend yield over the past 5 years, we have a 5-year average of around 4.35%, and we're currently sitting at 5.58%. So it could look a little undervalued based on that higher dividend yield, depending how you look at it. And the forward-looking price to AFFO ratio is also sitting nicely at 13.5%, which is significantly lower than their 5-year average, making me a little more comfortable about potentially purchasing more of these shares. So going over this calculator that I created on my spreadsheet, we can see here that in 2019, the dividends paid out were $2.71 per share. Fast forward to 2023, they were $3.051 per share for the year. We can see that from 2019 to 2020, there was about a 3.1% increase, and then a 1.4% increase from 2020 to 2021, another 4.73% increase from 2021 to 2022, and lastly, a 2.83% increase in our past year. And moving over to our AFFO per share, we can see that at first it increased pretty slowly, but we had very quick increases from 2020 all the way to 2022. Now, I think that we still need the full year results for 2023, so I'll see what happens when that comes out. But otherwise, we're looking at about a 1.8% increase for this year. As I mentioned before, its past year performance has been terrible, lagging the S&P 500 by a significant margin. And even if we jump into the 3 and 5 year graphs, we can see here that it is still lagging by an incredible amount, so it has not been doing so well in recent years. However, historically, Realty Income has outperformed the S&P 500, so I look forward to seeing how it starts performing once interest rates do go down. Now, I just wanted to show you guys real quick what a big difference reinvesting dividends makes. Of course, you're still in the negative for the past 5 years, even if you reinvested those dividends. But if you look at that difference, you could have been minus 22% just based on price, but a minus 3% return with dividends reinvested. Also, something to consider is that if you bought during the drop after COVID-19, you would actually be sitting at a way nicer position than if you bought before then. Now, if I pull that up real quick, you can see what a huge difference that makes. Buying at April 1st, 2020 would have actually given you a 40% total return and a 16% price return if you're not reinvesting those dividends. Now, in Seeking Alpha, I can't graph their price to FFO ratio, but if we look at the regular price to earnings ratio, we can see that based on that, it does look a little undervalued compared to what it was trading at historically. Now, just because something is undervalued doesn't mean that it's a good buy, and just because something's overvalued doesn't mean it's a bad buy, so keep that in mind. As I mentioned before, one thing that really concerns me about this company is how quickly their shares outstanding have grown. They basically doubled or even more than doubled in just the past 5 years, which is not good if you want a larger ownership within the company. I really do hope you guys enjoyed seeing some insight as to why I'm buying Realty Income for my Roth IRA. Make sure to let me know down in the comments below whether you're buying Realty Income or if you're planning on it at some sort of price point. I know some people are waiting for it to hit sub 50 again, so we'll see if that happens soon. Also, if you're instead investing into other companies, let me know down below, especially if they're REITs. I'm very curious to see which ones you're interested in. For those of you that have been asking to see how I made my portfolio spreadsheet, I actually just posted my first tutorial on the channel last week showing how I made my future outlook simulator. If you guys are interested in that, make sure to check that video out. I'll put it right here at the end of the video. And if you do want to see more tutorials, definitely let me know. For the rest of you, if you do want to see which new company I just purchased, make sure to check out this video right here, where I go into detail as to my decision. As always, I hope you guys enjoyed today's video, and I will see you next week.